Good afternoon, everyone. I am CA Hemant Loya, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be a moderator for the 56th webinar on tax audit clauses 27, 28, 30, 33, and 43, and AS 11 and AS 2. In a short while, we will start this webinar. First, I would like to apprise you about CPE committee. In today's ever-changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of their game while adapting to new requirements and norms. Therefore, it is imperative to aim to be up to date, to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspective. In this context, continuing professional education facilitates professionals to maintain, improve, and broaden their knowledge, skill, and expertise to achieve their professional goals through webinars and seminars, etc. The program for today will be as follows. We have two sessions of 1 hour each, and topics will be tax audit clause 27, 28, 30, 33, and 43. And second, AS 11, the effect of changes in foreign exchange rates, and AS2, valuation of inventories. Our eminent speakers will talk about above mentioned two emerging areas of professional interest. Now I would like to introduce our chairman CP committee, C. Satish Kumar Gupta sir. C. Satish Kumar Gupta is presently serving as the chairman of the Continuing Professional Education Committee of the ICAI. In addition to this role, he is also the chairman of the Reading Directorate and vice chairman of the Committee for Members in Practice for the current term. He previously served as the council member of ICAI from 2019 to 2022. He is a renowned speaker and author specializing in income tax assessment, search, survey, and professional development topics like goal setting and career planning. I would request C. Satish sir to please uh, guide us.
Thank you, Hemant. Thanks a lot. My brother in the council, and to whom I say Master of Income Tax. There was a degree in Master of Commerce, Master of Arts, and I think the Master of Income Tax, the degree rightly we can give to Piyush Bhai. So Piyush Bhai is doing wonderful work in the council, especially in the Direct Tax Committee. And I started this year my council in his leadership when we met with the select committee on the income tax bill 2025, and to our utmost surprise and pleasure that we could get the work done, that now the definition of accountant is intact. So thank you, Piyush Bhai, for taking the lead and convening the government that it is the chartered accountant who are the real accountants for the purpose of income tax audit. Thank you. Thanks a lot. And the another speaker, my younger brother from Jaipur city, a very dynamic and going forward, wonderful Anup Rata, and Chairman Jodhpur branch, who has kindly given his consent to be moderator of this particular webinar, Hemant, and team CP under the leadership of Payal and others, and team Tech. And my dear friends who are attending this webinar, despite our, I know that these are the festival days and you are busy, but I would like to quote one member. I received a call yesterday. He said, are you going to hold the webinar tomorrow also? And yes, we are holding. So he was very happy. And he told that the webinars you are doing is really wonderful. And the speakers you are inviting are really awesome, and they are adding values in our knowledge. So I am thankful to the President ICI and the Vice President ICI, the entire council, for giving me this opportunity to head the CP committee this time, and to give that opportunity to organize as much as the program on education. So friends, I don't want to speak much because Piyush Bhai and Anup both are going to take the very important topics. And these are the days of the tax audits, and we all need that particular knowledge that how to deal with the every class of the tax audit. Yes, we all know, but the things which we are being told by the experts are really worth, and we should take give attention to all those new things which we come to know. So this is something which I want to talk today. But simply, I would like to say that we are going to launch the new portal of the CP committee by November, I can say. And after that, we would be in position to give the CP credit only on real attendance basis. I think you all must welcome that particular initiation of the ICI, and we are now well matured to deal with all these things seriously. Thank you very much, friend. Thanks. Not much time in between you and Piyush Bhai. Piyush Bhai has very big agenda today, and I know that after deliberation there is some value addition definitely. Thank you. Over to Hemant.
Thank you, sir. Thank you for your invaluable insights and contributions. Your input added great value to the discussion, and we truly appreciate your time and expertise. Thank you, sir. Now, I take pride to introduce our first speaker, CA Piyush Sonraji Sajed. CA Piyush is a CA with 25 years of professional experience and served as a senior partner at firm in Mumbai. And with providing a strong foundation in finance and taxation, he specializes in tax litigation and advisory. He has been a Central Council member of the ICAI for two consecutive terms, 2022-25 and 2025-29, and has served on all the three standing committees. He is currently the chairman of the Direct Tax Committee and vice chairman of the Expert Advisory Committee of ICAI, and has represented India internationally as a member of the Working Committee of the ASEAN Federation of Accountants, technical advisor on the IAASB, and member of the SAFA Committee on Physical Designs. Now, not much taking time, I hand over to welcome CPUZ for his speech. Thank you, sir.
Thank you very much. A very good afternoon to all the participants. CA Hemant Loya, thank you very much for your introduction and moderating this session. The respected chairman and my CA Central Council member senior, I would say CA Satish Gupta ji, who is the heading chairman of CP committee, and a wonderful work, a great series which he has started since last week. And I was also delivering lecture on certain clauses of tax audit, a great initiative to update the members, especially in month of October when we know that you are at the helm of tax audit. And the idea of this webinars obviously is that if your problems could be resolved immediately when you are doing this work, I think so. Nothing like it. My kudos to you. A great work has been done by Satish ji also on the Union Directorate. I've been seeing. You will see a lot of changes coming up. A lot of fields being added, which will make more transparency as far as generation of union is concerned, and the trust which is placed by various government bodies, which has been reposed. And that trust, keeping that trust in the mind, changes which have been made by the Satish Gupta ji under his leadership on the Union Directorate. I really thank him. Thank you very much for giving me this opportunity also, Satish Gupta ji. It's my privilege to be part of CP committee as a lecturer. And especially on a topic of direct tax, when I also come as a chairman of a direct tax committee, obviously it becomes imperative for me to speak to the audience today. Coming to very important subject, of course, I will be dealing with the certain clauses because I know in this series of webinars, which is 56th in line, but the last week continuous seminars have come, and more or less all clauses are completed. So I've restricted my to certain clauses of 27, 29, 30, 33, and very specific clauses, which are very important clauses. And I always say that tax audit is important, as rightly said by Satish ji, that it has been now upheld by the Parliament also, by the way of Select Committee in the Income Tax Act 2025, that the chartered accountants are only equipped to do any accounting and auditing function, which is a prerequisite for a tax audit. And why this is necessary? Obviously, I would say if the confidence has
Technical issue, please wait. Piyush sir will join within few minutes.
Presentation, I'll again rejoin. But yes, we'll continue, Hemanji. So I hope we are online to all the participants. Sorry for the technical issues which have started, and therefore this issue has come up. I tried to switch off again and bring it with another. Now I'm connected with my mobile, but I'm trying to connect it with my desktop also so that I can run the presentation. That's what an idea is. Uh, so
So
I have come. I'm back.
सब कनेक्ट हो गए लैपटॉप से.
yes, हो गया. So sorry. So I was at the point coming back. Sorry for the technical issues, but yes, I was at the point that the confidence which has been reposed by the government, that if there was a 2 point representation given by the CBDT to the parliament, that is the select committee, that yes, only chartered accountants are equipped to do accounts and audit. So on a 2 point, first, whether other professional institutes can actually do an tax audit, legally they said no. There are three different acts and all three have a different objectives. Number one. Number two, for the purpose of the tax audit, the knowledge of accounting and auditing is required. And on the merits, chartered accountants are only equipped to do it. So that is the confidence which has been reposed. Whenever I travel as a chairman of a direct tax committee, I've been asked the questions that a lot of responsibility has been increased of a chartered accountants. Responsibility in relation to reporting in clause 22, 43BH, reporting in regard to clause 44, GST reconciliation, TDS. So these are very difficult and it is putting a lot of responsibility on burden and chartered accountants. My request to all the members, please keep it in mind. Only because of those difficult questions, the trust has been placed on chartered accountants. Do you expect that in tax audit, I should give only an information which can be given by an accountant and not by a chartered accountant? The questions and the answers which are not available with the assessees, which are not available with their accounting staff, are being expected to be certified by a chartered accountant. आप ये सोचते हो कि only there would be a general information and you will certify that report, then obviously tax audit will never be valued the way it has been valued today. Courts have time and again have been held that if the audited financial statements are certified by the auditor and tax audit report is certified by an auditor and there is no disclaimer, there is no qualified opinion, then the assessing officer cannot reject the books of accounts unless he can show that there was a graving mistakes in the financial statements. Audited books of accounts are sacred. That's what Madras High Court says in one of its judgment. Madras High Court has said that audited books are sacred. What do you mean by sacred? It's like a Bible. It cannot be rejected. So that's what the trust has been put on this audited books of accounts. Please do, therefore, be very, that tax audit is a very important function. Yes, whatever difficulty it encounters by the department, they try to actually incorporate in Form 360 because they know to answer to such a difficult questions is only available to a chartered accountants who are well equipped, well knowledgeable, and that's what the trust has been placed. I'll just tell you one more development which is happening. There is a committee being formed by the board, by the member legislation for revision in Form 3CB. As you know, Income Tax Act 2025 is already coming. So all the rules will be coming maybe in the December. Income Tax Rules 2025 should come in December. And at the same time, the forms which would be applicable under Income Tax Act 2025 are being redrawn. As a part of that committee, we were invited as an Institute of Chartered Accountants of India to give our suggestions in revision. So the Form 3CD, 3CB, 3CA would be revised. They want suggestions from the Institute of Chartered Accountants. So obviously, the number may not be same. It may not be 3CA, 3CB, 3CD anymore. There may be new number coming in. But the important is the tax audit formats are going to be changed from Income Tax Act 2025. Not for this year, that is financial year 25-26. It may continue with small revisions, but 26-27 it will be. DTC, Direct Tax Committee, has already sent emails to all the members seeking suggestions on those revisions. I do want, you do write to me, you do tell to me that I receive a calls that this could be changes can be made in Form 3CB, redundant clauses can be deleted, or new clauses can be added, which will help the department to assess the correct income tax, which is the objective of the tax audit, to assess the correct income. No extra tax should be paid by any assessee. No legitimate taxes should be avoided. That's an objective of the tax audit. So my request to all of you, if you have any suggestions on revision in this Form 3CB, revisions in Form 3CA or 3CB, please do write to the institute. You may write to CPE committee, you may write to DTC committee. Each and every suggestions which you will be sent, I can assure you that it will be considered at the CPE committee also and the direct tax committee also. And if found appropriate, we'll incorporate in our suggestions and send it to the department. And believe me, those will be considered very well. All the suggestions which you have been sending are being considered. And I always tell, whenever you suggest, please do not keep it in mind that the person to whom you have sent a suggestion, he should accept it. It's not necessary. He may not accept it today. He may have a different view. Our duty is to send suggestions. He may not accept in year 1, maybe year 2, maybe year 3, but in year 4, yes, he will do it. I'm just giving you an example. In this Income Tax Act 2025, in its making, when we gave a comprehensive review suggestions, more than 113 sections were to be deleted was suggested by ICA, and that was accepted. When we said that there shouldn't be any changes in section 288 related to accountant paramateria Income Tax Act 513, they accepted. When we said that you please convert all the TDS sections into a schedule, they accepted. Of course, they have not accepted many more also probably, which will be now giving by way of pre-budget suggestions. The budget, which will be coming in Feb 2026, will look into it revision of Income Tax Act 2025. So please mind it, this Income Tax Act 2025 may get amended before it gets implemented through a budget 2026, for which a pre-budget suggestions are going. Again, suggestions has been sought from each members through a Google form, through a DTC website. If you have any suggestions on Income Tax Act 2025 for the changes to be made before it comes to an effect from 1st April 2026, please do send us. We will be sending this pre-budget document, and we'll not only be sending. As far as pre-budget is concerned, Institute is generally invited by the CBDT chairman for making a presentation there. So we will be making a presentation. What are our suggestions? Why we do want some changes to be done? Whether such changes along with the justifications. So it would be taken well. So I thought I'll just give you a background. The last, before I go to actual clauses of the tax audit, the CBDT has also formed one more committee, I'll tell you. And this was at our request, in fact, that you please on the quality of assessments. I know a lot of people do say that in faceless quality of assessments are not there. In appeals, I keep on filing responses, but I do not get orders. Orders are completely never, our responses are not considered in the orders. They will just reproduce, and in one line they will say it's not acceptable and the addition is made, or not acceptable, appeal is dismissed. Either of. I know that. So a committee has been formed by the board, which is headed by Principal CCA. And that committee was supposed to meet yesterday, but due to certain medical emergencies, it could not be in the Mumbai and in Delhi also. So, of course, we have been invited with the suggestions to be made purely on quality of assessments. So, what I'm trying to make a point, Institute and CBDT is continuously engaging on various technical aspects. Various technical, whether it's revision of Form 3CD, new rules is concerned, revision of ITRs also, for which again I sent a Google form. So revision of ITRs is also going to happen in a two-way process. One is for 26-27. assessment year, and one is for the under the new act also. Then quality of assessment changes, quality of faceless assessments. That's what the most important things are there. And you please keep giving your suggestions. If you do not give suggestions, and if we are not able to forward to CBDT, then of course we cannot blame anybody that those people are not changing. We have to send those suggestions. If they do not accept it, does not matters. In the future they will. Coming to a very important topic of tax audit. Uh, I'll just share my presentation. Uh, yes. So, as said in my initial opening remarks also, I would be covering clause 27, 29, 30, 33, and 34. But as a being a tax auditor and being a chartered accountant, I always, whether I'm doing any, if I'm giving a lecture on one particular clause or on a overall practical aspects of tax audit, I try to go on to the objectives of tax audit because it should be reminded and kept in the mind. Why was tax audit introduced somewhere in 84, 85? Before tax audit was introduced, there was 100% cases were scrutinized. Even a return of a salaried person which was verified was selected for scrutiny and the physical assessment used to take place. So government thought that we should bring down this scrutiny process. Why we should select all such scrutiny and we should rely upon some experts who can give us a detailed information in regard to business assessments. Obviously, salaried and all who are not under the audit, their percentage of scrutiny is already reduced. But even in the audit cases, they wanted to do a reduction. So obviously, the trust was imposed in the chartered accountants and audit was introduced with an objective that the report, the disallowances, allowances, the information required for the purpose of assessment will be reported and certified by a third party expert, that is a chartered accountant, which will help in determining the correct total income. And after that, once that is determined correct total income, which is as good as certified based on the Form 3CD certified by an auditor, there would be no requirement of the scrutiny. So from a 100% scrutiny, because of this tax audit, today we are in a world where the scrutiny cases are not even 1%. So a tax audit has played a very important role in this. Obviously, as I say, and as retaliated by CBDT to the Select Committee of Lok Sabha, that tax audit involves examination of accounts and the audit. So examination of accounts is important. Please do not jump to Form 3CD. Form 3CD is furnishing particulars of certain areas from the books of accounts. First is to see that books of accounts are properly drawn, and therefore examination or review of accounts is proper. It is drawn as per the accounting standards, applicable accounting standards. If it is companies, applicable accounting standards are to the companies. If it is not a companies, accounting standards issued by ICI. Of course, for the companies also, they are issued by ICI, but they are notified by under the company's rules. So you need to look into it. Then all the accounts are drawn as per the applicable accounting standards and guidance note issued by the ICI. It also ensures the tax audit objective is to ensure the correct implementation and proper compliance of tax provision. So as a tax auditor, you have to have a knowledge of your financial books of accounts, accounting standards, as well as Income Tax Act. So it's much larger than the statutory audit because you are doing a statutory audit also. If you read Form 3CA, you rely upon a statutory audit report and then state that it's a true and correct as far as particulars furnished in the Form 3CD. If you see 3CB, you give a two-way certification. First, you certify as a statutory auditor that financial statements, that's a balance sheet and profit and loss account, show a true and fair view. So you give an opinion on the financial statement. And secondly, then you say that the Form 3CD is true and correct. So you have to have two responsibility as a tax auditor, and therefore the tax audit is very important. Third, the objective is to enable the tax authority for verification and assessment. So it's to determine correct total income, which I mentioned earlier. So our responsibility, express opinion on financial statements. For that, obviously, you will have to obtain sufficient and appropriate audit evidence. It cannot be just on the basis of tally. You just draw accounts certified. For any figures which are reported in the books of accounts, you ensure that proper auditing standards are being followed, proper evidence is verified and documented as required by our auditing standards. And third, largely, when then I come to a last part is to verify statement of particulars to be filed under the Form 3C. So these are the three important areas. Please keep this in mind. At the cost of repetition, also, as I always say, that tax audit is one of the most important functions. Please keep it in mind. Now, very specifically, because I have another 30 minutes, I'll try to briefly cover the clauses which have been allocated to me. Then we will be listening to another speaker on AS11 and AS2, which is a very important topic, I know. And so I'll try to finish in my 30 minutes before 1 o'clock. That is coming to clause 27, which is divided into two subclauses. One is A and one is B. A is in regard to reporting on Senvet credit. 27A deals with reporting of Senvet credit. It is basically a reconciliation which you are giving. What is an opening balance? What is credit availed? How much is utilized out of it? And what is the closing balance? So it's a reconciliation of Senvet credit. After introduction of GST on 1st of July, technically now Senvet credit is not much relevant because Senvet credit deals with the excise law as well as the service tax law. After 1st of July, it is now only applicable to certain products like petroleum, tobacco, and liquor, or maybe something else. Now, the question that arises whether the ITC details, that is input tax credit in GST, should be reported under 27AA. If you see my guidance note very clearly says that I have gone by notified form. Though the utility of Form 3CD refers to an ITC, e-filing utility. But the notify form only talks about Senvet credit. If you see the preamble of our guidance note issued by ICI, it says that this guidance note has been issued based on the notified forms, because notified forms are as per the law. Utility is not issued under the law, and therefore I cannot go by an ITC. So if you actually go by a notified form, there is no requirement of reporting of an ITC under that, and that is clarified in the guidance note also. But of course, one may, if the information is available and if it makes sense to a reader, one may choose to report it because it's a extra information, a better presentation. Nobody helps. But because the guidance note is drawn on the basis of the notified form, guidance note states that ITC is not required. Only Senvet credit, because the notified forms talks about Senvet credit. I thought it would be relevant to bring it down. And we have already made a representation in the revision of Form 3CD, which is going to happen, that now this Senvet credit can be replaced, or ITC can also be further included under this particular clause whenever it comes into the new form. So that's the one area. Of course, what is the checklist which you should ensure? That this 27A, I said, is only relevant to certain products which are petroleum, crude, diesel, petrol, aviation, turbine fuel, natural gas, and tobacco, because otherwise Senvet credit is no more relevant after GST coming in. Obtain from the assessee, you will have required to obtain a reconciliation of Senvet credit as per the books of accounts and relevant excise records. So your opening balances, what is availed, what is utilized, and closing balance, all should tally with the excise records. If they are not reconciled and whatever figures you are reporting, then you should clarify it in your observation column of Form 3CB or 3CA, stating that what is the difference between and whether you have reported here as per the books of accounts or with excise records. Technically, here the reporting will happen as per the books of accounts. But if there is any difference between the books of accounts and the relevant excise records, you should make a mention in the your observation, and the reconciliation should be available in your documentation of the tax audit. That's what is very important. So if you see my para 5 of tax audit checklist on the screen, it says report figures as per books of accounts. State the basis of reporting in clause 3, that is observation column of form number 3CA, clause 5 of form number 3CB. That's what the most important part is. Obviously, para 6 on the screen shows what you have to report. Opening balance, state the shown in the balance sheet of the preceding year, which becomes the opening balance. Credit availed, you have to show what is amount debited to Senvet credit receivable account, whereas corresponding credit would be the supplier account. So when you acquire the goods for 100 rupees and there is an 18 rupees Senvet on that which is available, you will generally debit this 18 to Senvet credit receivable account and credit to a supplier because it has to be paid to the supplier account. This 18 rupees is Senvet credit receivable. So summation of all such credit receivable will be appear in credit availed account. Credit utilization is actual payment made through this Senvet credit receivable account. So there would be corresponding credit in receivable account and also credit which will be debited to an excise duty payable account. So you will have to look into those accounts and derive those figures. Closing balance, of course, will be shown as a current year balance sheet and it will be reported as a current asset in your balance sheet. Next item, very important. Second part of clause 27 is in relation to prior period items of expenditure debited to P&L account or income credited to profit and loss account. So it's a prior period items. So when it says items, it's expenditure or income. The tax auditor is expected to report any nature of prior period expenditure or income which has been debited to current year in the profit and loss account, but it is in nature of prior period. For the purpose of whether it's a prior period or not, you need to look into its crystallization. It may happen that there is some legal dispute under which you have to incur some expenditure, you have to pay some compensation, and the legal dispute is ongoing since your audit year, since the previous years, I would say, but it got crystallized, it got settled, and the order of court has come in the year, and when the payment has been made, obviously, such may not be a prior period item. Sales purchase returns during the year cannot be regarded as a prior period. And therefore, it's very important. Obviously, this clause would be only for mercantile system of accounting. Generally, in cash base of accounting, there won't be any prior period item because you follow cash basis. A very important checklist you need to keep. Point number one, of course, as I said, not applicable for cash system of accounting. You need to look into it. Second point, you need to see whether the assessee has been subject to statutory auditor, and if statutory auditor, whether he has reported any item as a prior period item in his statutory auditor's financial statements. If yes, you may consider that. Tax auditor, if it's different from the statutory auditor, he may have a different view also. So a statutory auditor may have reported as a prior period, but if a tax auditor feels that it's not a prior period item, you may not report here. But yes, you may give a comment and the observation in your Form 3CD and 3CD that why you are doing so, and according to you, why it is not a prior period item. If you are not subject to a statutory audit, obviously you yourself would be a financial statements auditor and you will have to scrutinize the general ledgers to identify such items. You will have to go into the narrations. What are the nature of expenditures which have been debited, or what is the nature of income which has been credited, to decide whether it is the nature of prior period items or not. For the purpose of determining prior period item, you will have to keep in mind definition of prior period items, which is given in AS5 and in AS8, depending upon which is the applicable accounting standard. You have to note the distinction between a prior period item and change in accounting estimate. So if I'm just making a provision for doubtful debts. So doubtful debts is a debt is continuing for 5 years. Initially, I made a 10% provision. This year, I decided to increase it to 50%. It's a change in accounting estimation. It's not a prior period item. So prior period item is something in nature of which you have omitted to cover up or debited it or record an income in the previous year will be treated as prior period. So please keep it in mind. You have to keep it in mind AS5 and Ind AS 8 based on which your accounting standards are being followed for the purpose of financial statements. Another clause is clause 29. There was initially a clause 28, which has been omitted, which dealt with section 56, subclause 2, subclause 7b. Because subclause 7b has been deleted and with effect from assessment year 25-26, it's no more relevant. So everything has been now incorporated under clause 29. Clause 29A and 29B. So clause 29 has been deleted, but clause 29A and B continues. A and B is much wider in the scope. It includes reporting of any amount which is in nature of income chargeable under the head income from other sources as referred to in subclause 9 of subsection 2 of section 56. You have to give the nature of income and amount thereof under this clause. Most importantly, what is 5629? Please note it. It is any advance money or other sum received during negotiations for transfer of a capital asset, which is subsequently forfeited due to non-fulfillment of terms of agreement by the buyer, shall be chargeable to tax under the head income from other sources. So there should be an understanding wherein you have received some, maybe you have received some amount in negotiations of transfer of capital asset. So you decide to sell your asset, capital asset, maybe a house property, maybe a business asset, maybe office premises, and you receive 10% as a advance amount. And the same is not, transaction is not gone through, and subsequently you forfeit that account. That will be reported under section 5629. What is important is the amount should be forfeited. In the books of account, an entry should be passed for forfeited. if the advance of 10% which has been received in the example which I told, and if you continue as your advances as a liability in your books of accounts, then it has not to be reported. But if it is forfeited in the books of accounts, it's taken to P&L or maybe to reserve. Somebody may be doing a different accounting treatment directly to a capital account in a proprietors or in a partnership firm, which should not happen, which is not permissible technically under our standards. Then within the such forfeiture happens, you will have to report it. Number one, not if the forfeiture does not happen. Number two, this is required to be reported if it is in respect of personal capital asset or stock in trade. So if it's a personal capital asset which is not appearing in the business books of accounts which are audited. I always tell there may be two books of accounts. One is a business and one is a personal books. You generally audit only business books under section 44A. You do not audit, you are not required to audit other personal books of the SSC, which may be consolidated for the purpose of ITR or the purpose of drawing a computation. So you do not report in case of the personal capital asset which is transferred, which was proposed to be transferred and some amounts were recurred because those are not under the audit. Similarly, it is not applicable to stock in trade. It is only applicable to capital asset. Any advance, a question, any advance received or forfeited towards sale of stock in trade, I've already said there is no requirement to report such amount unless and until it is forfeited by an act of the SSC. Further, stock in trade, not applicable. 56.2.10 is then another clause which deals with pertains to income from other sources in form of gifts, name gifts received which are taxable under 56.2.10. As you all know, 10 provides that where any person receives the following amount from any person, that he needs to declare such amount as income from other sources subject to certain exemptions. So there is an amount exempted up to 50,000. Immovable property, if received without consideration or consideration is more than the difference, the value of the property is more than the 50,000, or the consideration and the difference between the stamp duty value of the immovable property is exceeding 50,000, you need to report it over here. These are the provisions of 56.2.10. As an auditor, you will have to, what is your responsibility? I will come to you. Shares and securities. Supposing there is a receipt of shares and securities, auditor shall ensure that acquisition is through transfer and not through the issue of fresh shares by the issuer company, and verify that the fair market value of unquoted shares and certificate is in accordance with Rule 11 UL. So, as an auditor, you will have to insist, please give me a valuation certificate. If there is no valuation certificate, how will you report? How will you determine that the shares which have been bought is at a price which is equivalent to fair market value or not? Because if it is not equivalent and if it is a not at the lesser price than the FMV, the reporting has to be done. So as an auditor, whenever there is a transfer, whenever there is an acquisition of shares and securities, you will have to look into it and also report it over here and insist for valuation certificate under section 11, under Rule 11 UA. Immovable property. Similarly, for the purpose of reporting under this clause, if there is a difference between transaction value and stamp duty value of an immovable property which exceeds 50,000, the reporting is required. Assessor will have to have an adequate evidence that fair market value does not exceed the consideration, for the purpose of which, again, you will have to insist for a valuation report whenever there is an appreciation of the property. Obviously, without insisting for a valuation report, how can you do it? If there is no valuation report is been made available by the SSA, you may have to give an qualification or an observation in your Form 3CA, 3CB. So let's take an example. You acquire a property this year by way of an allotment letter. You have already paid advances, you have paid a consideration, there is an agreement for sale, but the registration does not take place. So what would be your responsibility? Whether you will report in the year when the registration is done, because the value of the stamp duty value would be only available when actual registration takes place. In my view, my personal view, the reporting will happen only in the year when the registration happened. One may argue there is no taxability in the year of registration because agreement was already entered earlier. But as far as reporting by the auditor is concerned, you can only do when the registration takes place. Next point is clause 30, amount borrowed on Hyundai. A very small clause, I've been told and I've been seeing my experiences. There is no much transactions happening. There is no borrowings nowadays happening on Hyundai, but it was erstwhile happening. So reporting under this clause is very minimal. Hardly anybody reports, maybe because the transactions are not happening or the people are not being able to look into it. So according to this section, where any amount is borrowed or repaid on a Hyundai or any amount due thereon is repaid to any person otherwise than through an account paying check, drawn on back, amounts so borrowed or repaid shall be deemed to be the income of the borrower or repayer in that year. So you need to report any amount which is borrowed or repaid on a hundi by a manner otherwise than through an account by check. This is the format. I'm just keeping it format which is in compliance with section 69 subclause D, just to ascertain that the amount which is borrowed on hundi or repaid is in accordance with the requirements of section 69D. Another important, I'm just moving it, being I think so this is the last tax audit series, and that's why the committee told me that let's also consider 30A, which is relevant to transfer pricing. It's relevant to international taxation or more. It deals with section 92C. Clause 30A requires that whether any primary adjustments to transfer pricing as referred to in subsection 1 of section 92C has been made during the previous year. And therefore, as you all know, the persons who are covered to whom the transfer pricing is applicable, who has actually entered into any transaction with an associated enterprise, that is an foreign associate enterprise, even of rupee 1, transfer pricing audit will be applicable under section 92C. And based on that audit, the prices auditor is required to determine the arm's length price and compare it with the transaction value. If you feel that the arm's length price is more than the, supposing I'm selling the goods and I sold the goods at 100 rupees, assessee has sold it at 100, but you say that arm's length price should have been 110, then the transfer pricing auditor will determine and suggest a primary adjustment of 10 rupees. Based on his report in Form 3CEB, 10 rupees will be added to the income of the assessee. Generally, a tax auditor has to report that in 3CB, what are the adjustments suggested by a transfer pricing auditor? You may be the same auditor or there may be a different auditor. So generally, a TP audit report will have to be obtained first and thereafter tax audit report will happen. And therefore, if you see the tax audit filing date where the TP is applicable is not 30th September, now extended in October, but it is 30th November. That is 30th October for filing TP report, and the returns it is 30th November. But this year it will be the same. So if there is some adjustment, primary adjustment suggested by TP auditor, you have to report in this clause 30A. What is the type of primary adjustment which is made? What is the subclause, subsection of 1 of section 92C? There are various clauses under what type of nature of primary adjustment, amount of the primary adjustment. And because there is a primary adjustment, means you are saying that instead of 100 rupees, goods should have been sold at 110. Whether that 10 rupees has been repatriated into India or not, you have to report the factual position. If yes, obviously you will factually say yes. And because that repatriation may happen after 6 months or 9 months, and this 10% excess 10 rupees which has been recovered or suggested in primary adjustment should be recovered along with the interest. Whether such amount was recovered with interest or not, the factual reporting has to be done. Generally, otherwise the secondary adjustment also happen if the primary adjustment is above 1 crore. So if you go further to this clause, so that 38, that is also a reporting of a secondary adjustment. So as if this 10 rupees has not been recovered, and if this primary adjustment is exceeding 1 crore, then you have to recover amount along with the interest. And those interest would be your secondary adjustment, which would be disallowed. And therefore, the reporting under the clause will also apply to secondary adjustments. Coming to another clause of 30B is in regard to interest expenditure, where an Indian company or Indian permanent establishment of a foreign company borrows funds from a non-resident associate enterprise and incurs interest expenditure exceeding 1 crore, the deduction is restricted to 30% of EBITDA. So you may pay so if your profit is 1 crore and you are paid interest of 1 crore, but that 1 crore interest paid to a non-resident associated enterprise will be only allowed to 30% of EBITDA, not profit. So if, and that too, if your total interest expenditure is exceeding 1 crore, not 30 lakhs. So if your interest expenditure is 3 crores, for an example, and EBITDA is EBITDA is 5 crores. So 30% of 5 crores is 1.5 crores. Then the deduction would be only restricted to 1.5 crores and not 3 crores. So the reporting under this clause requires in such case that first of all, whether you have incurred any expenditure during the previous year, you will have to say exceeding 1 crore. So if interest is less than 1 crore, this clause is not applicable. If it is more than 1 crore, the reporting under this clause, which is again a factual reporting, you have to say what is the interest amount, what is my EBITDA, what is 30% of that EBITDA, and what is the detail of balance interest expenditure brought forward, which was disallowed in the previous year, but may be allowed in the current year, you may have to give it under this clause. 30C is a very specific, it deals with an impermissible avoidance agreement under section 96. If you read section 96, you please keep it in mind that the principal commissioner or the approving panel has a power to declare any agreements or arrangements between the associated enterprise as an impermissible avoidance agreement. So they are impermissible because it avoids tax. If such action has been taken, then the reporting under clause 30C request. So I'm just going fast on this. Next is clause 33, deduction under chapter 6 and 6A. As I said, first keep it in mind, you have to report here whatever deductions under chapter 6A has been closed. Let's take an example. If you are already opting for a scheme of a lower taxation, that is a default tax scheme, then now chapter 6A deductions are not applicable. So if you are reporting in a clause A, 8 that yes, he has opted for a tax under section 115 back BSC for an example, then there won't be a reporting over here because it's not allowed, except two sections still continuous. One is 80 double J double A is still permissible. So you may report some amounts under 80 double J double A. But if you have not opted for default scheme, you want to go into a old scheme, then all deductions which have been claimed under chapter 6A needs to be reported here. The question may arise that chapter 6A deductions or a profit-linked disallowances arising from the business book should only be reported, not from personal book. So for an example, if I want to claim an ETC on PPF LIC, which is appearing in the personal books, which I am not audited, then obviously I should not report. Because if I am reporting at one place and in another place I am saying I have not audited those books of accounts, then it's not fair. So you will only report to the extent those deductions are arising out of the transactions reported in your audited books of accounts. Please keep that in mind. If you see my bold portion, it's clearly said auditors should report only those deductions which relate to transaction or items reflected in books of accounts of the business or professions. Unless and until you are auditing personal books, you cannot report from those books. Checklist, as I said, review all the deductions claimed. You will have to look into the act whether the deduction claims are correct or not, and then report it over here. Confirm the admissibility by way of documentations if you are reporting any amounts, because based on your reporting, chapter 6 and deduction would be allowed, and therefore you should keep it in mind that all the conditions in relation to those admissibility of deductions are fulfilled. Documentary evidence is available, receipts and certificates are available for your verifications and for your documentations. As I said, serial number 5 on the screen, if he has opted for taxation under any of the special schemes, then which may restrict deductions under chapter 6 only to a certain section, then you only have to report there. If there is any difference between assessor's claim and auditor's computation, report the admissible amount and note any judicial pronouncement that support the claim. As I said, confirm all relevant deduction and exemptions are included in tax audit report. If separate certificates or reports are issued by other auditors, like for ATIB, sometimes a separate certificate is required, then ensure that based on amounts reported in that certificate and reported in Form 3CD are matching. There shouldn't be any differences between both of sides. Coming to a very last clause for the day, and the next 5 minutes to end this particular session, we have 10 minutes. Clause 43, report in respect of international group. Again, dealing with an international taxation. The international group having a multiple offices, maybe in a group which is based in India and having a multiple offices, or for an example, that would be an of Hindustan Unilever having which is an international group and have an office in India. They have to report as per subsection 2 of section 286 of the Act. Every parent entity or alternate reporting entity resident in India shall, for every reporting accounting year, in respect of that whole group of which it is a constituent, so I may be a constitution of that particular group, furnish a report to the prescribed authority in the form and manner as may be prescribed. So they are required to furnish a report in this regard. As far as clause 43, as far as responsibility of the tax auditor is concerned, you have to just take the factual position. First, you need to determine that whether section 286 subclause 2 applies to me or not. So if you are an auditor of any constitution of the international group, you will have to first see whether under the provisions of 286 subclause 2, whether the group falls under the definition of international group. The threshold limits of the turnover are already given in the Act. You may have to look into it there, and whether I become a constituent. Once the Indian entity becomes a constituent of the part of international group, and I'm covered under 286 of clause 2, this clause becomes applicable. And then you will have to say, yes, because you are covered under 286 of clause 2, you will respond as this. And once you respond, you have to give all the details, such as whether report has been furnished by SSA or its parent entity or an alternate reporting entity. So 286 subsection 2 requires reporting in a particular form. You have to just say that you don't have to go into accuracy of that form, what is reported in that particular form. What you need to say is, if it is applicable, whether that form has been substantiated. There's also another clause for section 285 to SFT, wherein there is a bigger responsibility, wherein you have to state that yes, it has been filed, and also you have to state that it is accurate and clear. Whereas in 286(2), you have to only give the details of that form. Yes, it was filed, name of the parent entity, name of alternate reporting entity if there are two constituents in India. And I am auditor of constituent 1, but the filing has been done by constituent 2 because only one person has to file. There may be multiple constituents in India. If constituent 2 is filing, you have to say that he is the alternative reporting entity and he has filed it, and date of furnishing the report has to be given. So these points to be remembered. The forms which are required under 286 are in form 3CE AC to form 3CAE. You might know there are many forms which are under Income Tax Act, and in fact one of our suggestions which is now going to the department is to consolidate those forms, reduce those forms. Just take an example. I'm just going an offshoot that I have to exercise an option for the for coming out of the default scheme if I want to opt for the new scheme. Again, after filing that option, even in ITR, I have to state whether I have filed or not, yes or no. An auditor has to certify in clause A that whether such option has been exercised. So the same thing has been done at 3 places. And when tax audit actually gets completed before the filing of that optional form, that is 10 ICIE, whatever it is, how would an auditor, you are basically only, as per my guidance note, responding to that particular clause in the clause 8 of tax audit only on the basis of representation. So we have made a point that whether it is required to be certified at 3 places. Can it not be directly at ITR level? Why should there be a separate exercise of option certification by auditor? You directly, when you feel a computation idea, you say whether you want to exercise an option. If you say yes, your computation will be drawn on that basis. Tax would be calculated on that basis, and it's done. Why all such activities are required? So a comprehensive review of such forms is happening. Similarly, if you see, if I want to claim some profit link deductions, in my earlier clause, which I was just discussing, was clause 33, wherein you have to report. And there is already a separate form for purpose of certification of 80JJAA, that is additional employees deduction. You have a separate form certificate to be issued for 80IB. You have to give a separate form, you file that, a calculation has been done, and then what is the amount calculated has to be reported in clause 33. So then again, there is a double work which is happening. What we are trying to do is that while reporting clause 33 itself, you may give a link over here. Okay, yes, you're claiming deduction under chapter 6A, that is 80IA. This is the amount. Please give the calculation. So I will click it and the calculation will open. I'm sure. So that will reduce the forms. It will reduce the mistakes, genuine mistakes, wherein you actually forget to file the forms for such deductions separately. So that's one of the big suggestions which I'm going. Of course, coming back to my clause 43, again, the last clause, forms number 3CE AC to form 3CE AE. You have to furnish the details. You may take these details from the SSC in this Excel column. That's what my suggestion is there. I tried to cover all the clauses which were allotted to me in my time. And I thought because we have already Anup Ranta at 1 o'clock, I have been a little quick in this and try to cover all the clauses which were allotted to me. But my only request to all the members, my final request, that of course the tax audit season is already there. And if you have any questions, you may write to me on my email IDs, which is available on the website of the institute. I'll try to respond to them personally. If you have any questions or queries in relation to the tax audit, obviously there is a lot of helplines developed by the institute and the CP committee also, and the BTC committee. You may write to us, and definitely we'll try to answer each and every your questions. But my only final request, last request before I end my session, please do follow your guidance. Even if you do not agree with the guidance note, please do follow. Guidance note is like a Bible. There are judgments of Supreme Court which says that guidance note has been prepared by the body of experts, which is the Institute of Chartered Accountants of India. And if anything is stated in guidance note and if the auditor complies with it, assessing officer cannot reject it. That is a law. Unless there is a contrary position in Income Tax Act. You just see example of turnover definition, which is not given in Income Tax Act. It's only institute which says that profit and loss, minus signs have been ignored and you have to add for the purpose of F and O or options to arrive at the turnover to determine whether the audit is applicable or not. And the judges, courts have held that if the turnover given, there is nothing prescribed under the Income Tax Act, the turnover given in the guidance note should be followed. If on therefore, the guidance note is to ring fence you. Tomorrow, if you are put to a question that whether you have discharged your audit functions correctly or not, whether you were negligent, you can always say, I follow the guidance note. And I final line, it's always said that when Supreme Court gives an order, you may not be happy, but it's final. You have to live with it. When it comes to accounting and audit, any standards, any guidance notes issued by the institute, you may not be satisfied with it. If you're not happy with it, write to the institute. We'll try to make amendment in the forthcoming amendments, revised guidance notes or standards maybe. But till the time they are amended, they are final and it's binding. So please do follow. With this, thank you very much. I would like to recognize Anup Ranta, who has joined. He was in the start only, who's the next speaker, who is going to speak on a very one of my favorite topic of AS11 and AS2, a very important topic. It impacts my tax audit also, I know. And thank you very much, Hemant. Thank you to the CP committee for giving me this opportunity. Thank you. Over to you, Hemant.
Sir, we have certain query from members. Uh, First query, a partner is in professional firm getting remuneration. Can he file return under section 44 ADA and claim 50% deduction?
See, there are two views. I'll tell you a very good question you have raised. Whether the partner in the professional firm, whether when he is getting a remuneration, whether he can file a return under section 44 ADA. See, 44 ADA is a beneficial provision. Now, there is a one judgment which is against you of Madras High Court, which says any remuneration received from a partnership firm is not your turnover. So once it's not your turnover, the total income will be taxed and the 44 AD will not be available to you. But that is in perspective of 44 AD, not in perspective of 44 ADE. Because the words used in 44 ADA is the gross receipt. A partner who receives a remuneration from a firm, for him this becomes a gross receipts. And there is a judgments which everybody would agree from those gross. If I have incurred any expenditure, so called Chaya and Doshi, and they give me a remuneration, but they don't give me car. For my car, for my mobile, all those expenses allowable. So if the expenditure is allowable, one may argue that why not this deemed expenditure is not allowable. For an example, if my remuneration is 20 lakhs and I've incurred an expenditure of 11 lakhs, I can claim that. But if I want to don't go into an audit and claim 50%, in fact, I want to offer more tax, why not allowable? So one may can take a view. But yes, Madras High Court, as of today, it stands. It would be a debate. Personal view, stick personal view. Yes, one can claim if it's able to substantiate I have incurred expenditure for earning a remuneration, and that expenditure should be the extent of 50%. 10% क्या और मैं 50% always that.
So one more query. For an individual SSC, we audit only business accounts and prepare audit report. However, if the person has other personal income, including other property business vertical, which may be audited by another auditor, how can we handle such scenario?
So during my presentation, I said there are two aspects to it. That the first, if I have a business transactions in those books of accounts, recorded in those books of accounts. I will not do a personal audit. As I said for chapter 6A, if you recollect that if chapter 6A, LIC, PPF payments are appearing in my personal books, I will not, because those are not audited. But as you said, there are certain personal books wherein certain proprietary business is done. And if somebody else is an auditor, that for the purpose of tax audit, there will be one single auditor. Auditor of one proprietary business. Do
So
audit of
last
that.
query.
And yes.
So one last query. It is related to bad debts. Query is bad debts return of disclosure in tax audit report clause 13, 21 or 26.
You are saying whether I need to report a bad debts written off disclosure in tax audit report, provision for bad debts in books which was disallowed, now written off in debtors account. What I have understood is that you had created a provision for bad debts, right? That time it was disallowed. Now you will write back the provision and do a write-off in the debtors account. It's an allowable expenditure. So technically, you need not have any reporting requirement as per se in the income tax act, in the form 3CD. When you write back the provision, it's not taxable. So you will not report in the clause anywhere. In fact, when you draw a computation, that write back is not taxable and the actual write-off is allowable. So write-off will be available as an expenditure in the bad debts account. You will claim that, and the write back of the provision would not be taxable, which you will be reducing from your computation of it. That's all. But form 3CD will have no impact, in my view.
Thank you, sir, for clarifying the queries of members. Now, we extend our heartfelt thanks to CCM CPUC for his enlightening and insightful deliberation on income tax. Sir, your valuable guidance and practical perspective have enriched the knowledge of all participants and made the session truly meaningful. We deeply appreciate your time and contribution. Thank you, sir.
Thank you.
Now we move to our next session. We have CA Anup Mehta, sir. I am proud to invite CA Anup Mehta, sir. First, his profile. Sir has over 14 years of professional experience specializing in forensic audit, fraud investigation, and information system audit. He has led several high-value forensic and investigative audits for bank, stock exchange, and regulators, leveraging data analytical and AI-driven tools. He currently serves as Secretary of the Tax Practitioner Association Jaipur, contributing to CP program and professional development initiatives. Welcome, Anup sir.
Good afternoon, sir. Good
Good afternoon.
afternoon.
Welcome, sir.
Good afternoon to all. It gives me immense pleasure to welcome everyone to today's continuing professional education session organized under the aegis of CPE Committee of Institute of Chartered Accountant of India. At the very outset, I would like to express my heartful respect and gratitude to CA Satish Gupta sir, Chairman CP Committee of ICI, a visionary leader, guide, and mentor who has been a true source of inspiration to me, both in my professional career and my personal life. His commitment to the cause of knowledge dissemination and professional excellence has always motivated us to continuously learn and evolve us for better professional. My sincere regard to CA Vishnu Agarwal sir, Vice Chairman CP Committee, whose dynamic leadership and constant encouragement ensure that every program under the committee adds real value to our member and contribute to overall growth of our profession. Further, a very warm welcome to our distinguished speaker for the first session, CA Piyush Sajay sir, a name very known for his deep knowledge and practical insight. Sir, it is truly a privilege to share this with you today. I have personally had the opportunity to learn a great from your session, which always blend conceptual clarity with practical wisdom. I would also like to acknowledge our learned moderator for today, CA Hemant Loya sir, who has been gratefully coordinating and guiding this program. Sir, your dedication and structural approach always ensure that session remain interactive, meaningful, and value-driven. So, further, a special note of appreciation must go to the ICI technical team who has been working tirelessly behind the scene to make this program technically seamless and successful. Their efforts truly reflect the Institute commitment to ensure continuous learning for members across the country. And finally, my heartful thank to all my professional colleagues and participants who have joined today's session. Your participation reflects our collective commitment toward lifelong learning, professional development, the very essence of being chartered accountant. With this word, I again extend a warm welcome to all present here and look forward to an insightful and interactive session on Accounting Standard 11, the effect of change in foreign exchange rate, and AS2 inventory valuation, where we explore its practical aspect, real life implication, and key areas that require auditor uh, attention. Now, I see Anuprata, partner in C. Mashwari and Company Jaipur. I extend my heartfelt thanks to CP Committee of ICI giving me the opportunity to address today's webinar. Our topic today lies at the heart of accounting, integrating, understanding, and applying AS11 and AS12 in real life situation. Both these standards directly influence a company profitability, net worth, and auditing report. Over the next 50-60 minutes, we will explore the practical case study audit insight to make this standard more meaningful to our professional practice. Now, I'm sharing my screen just for confirmation. Is, is it visible? Thank you. Just so moving forward, what are the basic perspective for this AS11? Objective of AS11 is AS11 prescribes how to account for the transition in foreign currency and translate financial statement of foreign operation. It ensures that balance sheet reflect the real impact of currency movement on monetary asset and liabilities. Key concept Key concepts. Some definitions are in AS11, that is monetary item. Normally, current asset, with some exceptional cases, are classified as monetary items, that is cash, receivable, payable, loan, restated at closing rate. Non-monetary item, fixed asset, inventories, investment carried at historical rates, historical costs. Uh, In next, integral and non-integral operation determine if exchange difference goes to P&L or FCTR. Foreign exchange contract, in some of slides we will discuss about foreign exchange contracts, premium or discount, how we can treat that in our financial statement. So why this ACE 11 is important to us? Foreign exchange fluctuation can drastically impact our uh, 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 financial statement and reported profit and net worth. This difference not only impact accounting but also have implication of loan conveyance, taxation, and creditworthiness. So a recent example is the IndusInd Bank reporting, where some forex transaction is not properly disclosed, so having major impact in the network. So hence, auditor must, as the auditor, must ensure that monetary item are properly translated and disclosed. We can move to the case studies. The first case study. Now let's move our first practical case under AS11, which deals with the effect of change in foreign exchange rate, specifically foreign difference on capital WIP. In this example, the company had taken foreign currency loan of USD 5 million for setting up a project. The loan was initially recognized as exchange rate of 82 per USD, but the by balance sheet date, the exchange rate moved to 86 per USD, resulting in a foreign exchange loss of approximately 2 crores. Now the question arises, how should we, this loss has been treated in the books of accounts. Under the general principle of AS11, such exchange difference are charged to P&L account in the period in which they arise. However, there is one notification, means a para 46A of AS11, which provide a relaxation for exchange difference relating to the long-term foreign currency monetary items. According to para 46A, if the loan is taken for acquiring a depreciable asset, the exchange difference may be capitalized and added to the cost of the asset. If the asset is still under construction, as in our case, if it form part of capital under construction as capital CWIP, sorry, the forex loss should be added to CWIP. Subsequently, the project is commissioned. This increased cost becomes the part of asset depreciable basis and is written off over useful life through the depreciation. From the aspect, what we have to check and the few key points I will keep in each slide. Verify the company has consistently applied this accounting policy for the capitalization of the exchange differences. Ensure that appropriate disclosure is made in the note of account about the treatment of such loss under para 46A. Check the similar item across various projects or assets are treated on consistent basis. Means some item is not capitalized and some item are capitalized. So we have to check that uh, uh, the company is following the policy on consistent basis, and inconsistency may impact comparability of financial statement. So the key takeaway here in the forex difference on long-term foreign currency loan used for capital project need not always hit the P&L. They can be capitalized under para 46A, but with full disclosure and consistent application. Now, case 2 and 3. Two cases are merged, means the basic case let case to relate to the export receivable. Suppose a company invoices the export of USD 50,000 USD at 84 rupees, and the amount is later realized at 85. Under AS 11, this is a monetary item, so we must revalue at closing rate, and the 1 rupees per USD should recognize in profit loss. As an auditor, we must check the rate applied is benign, preferably TT selling rate, and the gain and loss is properly supported by bank realization advice. Now, case 3, deal with foreign branch translation. If the branch operates as an integral part of entity, say a UK branch of Indian parent, then the exchange difference goes to the P&L. But if function as non-integral and independent subsidiary, those difference moves to the foreign currency tra- translation reserve FCTR. So the audit focuses here on the correct classification, whether the branch is integral or non-integral, and ensure the translation is performed consistently each year. Now move to the case 4 and 5. Case 4 relate to the forward contract. Suppose an entity enter into the forward contract to hedge a USD payable at 84 when the spot rate is 83.5. Under AS 11, the forward premium of 0.5 per USD is amortized over the life of that contract, and may any mark-to-market changes are recognized as per para 36. As an auditor, we need to inspect the forward contract confirmation, check expiry dates, and verify whether the accounting entries are supported by M2M MTM statement for the bank. Now, case 5. The foreign account, a company held maintain a balance, say USD 50,000 in an overseas account that is a monetary item under AS 11. It must be revalued at closing rate on the reporting date, and the resulting gain or loss should be recognized as a profit loss item. The audit focus is here. Verify the revaluation entries and passed correctly. Ensure the rate applied is consistent with the RBI TT selling rate, and confirm the forex register and trial balance agreed. Let's now move to the case 6 and 6 to 8, which highlight three very different but equally important aspect in the foreign exchange accounting. Case 6. So, case 6 here deal with payment made to advance to supplier paid before the goods are shipped. Under AS 11, this is non-monetary item. As I have said earlier, this some of current assets are also a non-monetary item. Here is we have to look that what are the real aspect as per AS 11. So this is an example, an exceptional case. This is a non-monetary item because there is no right to receive or obligation to foreign currency at the balance sheet date. Hence, no revelation is required until the delivery actually happened. Case 7 involved redeemable preference share denominated in USD. Since this share carries an obligation to repay, they are treated as liability under AS 11 and must be revalued at closing rate. Any exchange reference affect the profit loss account. Case 8 concerning the non-integral foreign subsidiary. In such cases, translation difference do not flow through P&L. Instead, they go to the FCTR forming part of shareholder fund. From the audit perspective, we must review the classification whether the item is monetary or non-monetary, confirm the underlying agreement, and ensure FCTR disclosure are consistent with the prior period. Means it will be consistent for the every period past practice followed by the company. Now we will take another next case, case 11. A party has foreign currency loan, a situation we will see in every corporate balance sheets. Suppose an entity has USD 2 million loans and 50% is has through forward contract at 84.5. Now, while the closing spot rate is 85 rupees. Under ACE 11, the hedge portion should be measured at contract forward rate since the exchange fluctuation is already logged in. The unhedged portion, however, must be revalued at the closing rate and the resulting gain or loss recognized in the profit loss account. And the hedge portion, that is zero point 0.5, is proportionately transfer to P&L, that is earlier we has discussed. From the audit aspect, this case reminds us to pay close attention to hedge documentation, ensure the contract actually relates to the underlying loan, confirm its validity period, and review unhedged exposure reporting in the notes to accounts. In short, half the loan is protected by forward cover, but the remaining half continue to carry exchange rate risk that must be reflected in the financial statement. So, next case is regarding dividend payable in the foreign currency. A situation often we have seen in where in MNCs and where there is a subsidiary of a company. Suppose a company declare a dividend when the exchange rate is 84 per USD, but by the time it actually paid, the rate rises to 86. This result in exchange loss of 2 per USD, which must be recognized in the P&L under AS 11. The audit focus is twofold. First, ensure that liability revalued at each reporting period until that liability has been actually paid. And second, check the compliance of AS 11, which govern event occurring after the balance sheet date, including dividend declaration. In short, even the dividend is a distribution. Any change in foreign exchange rate between declaration and payment still impact on P&L under AS 11. Now, next case is cancelled forward contract, which is both common and often misunderstood in the audits. Let's have a company had booked a forward contract at 84, but to cancel it when the market rate is 83.20. This cancellation created a loss of 80 rupee, 0.80 rupees per USD for a contract of USD 1 lakh, that is 80,000 rupees, which must recognize immediately in the profit loss account. Under AS 11, once a forward contract is cancelled or renewed, the unamortized premium or loss no longer qualify for deferral. Its expenses, it it will be booked straight away immediately. Now, as an audit perspective, it's crucial to obtain a broker or bank confirmation for such early settlement, verify that the corresponding accounting entries match, and ensure that management isn't deferring the loss to the next period. In essence, when a haze is cancelled, its accounting effect should also be closed out in the same period. The next case is a foreign project which is executed by Indian entity, which is now normally we can see in MNCs, especially for EPC and infrastructure companies, execution project approach. Suppose a Indian company undertake EPC project in Dubai with all invoicing done in AD under AS11 as a key is to separate the monetary and non-monetary components. All monetary items such as receivable, payable, cash balances must be revalued at closing rate and each reporting date, but non-monetary item like fixed asset or work in progress remains at their historical exchange rate, that is the rate which they are initially recorded. From the audit point of view, we must ensure proper linkage between AS11 and AS7 on construction contracts so that exchange difference are recognized consistently with revenue recognition under the percentage of completion method. In short, the principle is simple. Use the closing rate for the monetary items and historical rates for non-monetary ones, and make sure revenue recognition is not distorted by the exchange fluctuation. For the next case, the case of redeemable preference shares having denomination in USD. While these are often presented as a part of share capital under ACE 11 and Schedule 3, such redeemable preference share actually carry an obligation to repay, making them financial liability rather than equity. Therefore, they must be revalued at the closing exchange rate, and any resulting gain or loss should be recognized in profit loss account. The audit aspect here is to ensure proper classification under Schedule 3, ensure the term of redemption at the agreement, and the confirm that any forex is appropriately disclosed rather than adjusted against reserve. This is a classic example of how accounting form or and legal form can differ. Substance over form prevail in AS11. Before concluding AS11 segment, let's quickly have some common mistake we often see in practice, especially during statutory audit and tax audit. First, treating as non-monetary asset as a monetary and unnecessarily valuing them. For example, advanced inventories or fixed assets should remain at historical cost. Second, ignoring exchange difference on outstanding creditors or debtors. Even small balance can affect true profitability if not at closing rate. Third, we see whether entities capitalize exchange loss without making required disclosure under para 46A as discussed earlier, that is non-compliance. Another common issue is not amortizing foreign contract premium, clubbing all forex gain and losses under other income, which hides the true financial impact. Lastly, many companies fail to disclose unhedged forex exposure, a critical audit point under Schedule 3 and ICI guidance note. As an auditor, our role to ensure that these disclosures are complete and that ACE 11 is applied consistently across all monetary and non-monetary items. So, closing remark for the AS 11. AS 11 is not merely a technical standard, it reflects management approach to financial risk. Auditor must ensure fair representation and full disclosure of currency exposure. So that is from AS 11. If we have any queries, we can take it after the AS2 combinedly or continue with AS2. I think we can move for AS2. Now moving from foreign exchange, just I will change the slide. 1 second. Just 1 second. Is it visible? So now moving from foreign exchange to another really critical areas, AS2, valuation of inventory. Inventory are often one of the largest current asset in the balance sheet, and yet they are the one of least or most misvalued and misunderstood item in the financial statement. Whether it is a manufacturing unit, a trading unit, or even a real estate developer, inventory valuation directly impact both profitability and taxability. The fundamental principle under AS 11 is simple. Inventory should be valued at cost or NRV, whichever is lower, but in practice, determining cost or NRV involve numerous professional judgment, overhead absorption, abnormal wastage, allocation of fixed asset, discounts, and obsolescence adjustment. AS2, what is not covered under AS2 means AS2 excludes some special cases like work covered under AS11, construction contract, AS9, revenue recognition, and shares debentures, or livestock held by broker. But for every other business, the auditor challenge is to ensure correct cost, competition, and NRV testing. In this segment, we will explore few practical case study that bring out common issues for valuation of damaged goods, slow-moving stock, inter-branch transfer to the treatment of rebates, goods in transit, course adjustment under changing price condition. So, moving forward, where accounting meet business reality and where professional judgment truly make difference. Before we get into the case study, let's start with quick overview of AS 11, valuation of inventory. So, the objective of AS 2 is to determine the amount at which inventory should be carried in the financial statement until the related revenue is recognized. This ensures that the cost of goods sold and profit are measured accurately. The core principle is very simple and straightforward. Inventory must be recognized or valued at lower of cost or net realizable value. This ensures we never overstate asset or profit by carrying stock at an unrealistic high value. In terms of the scope, is to exclude certain items that is already covered above. When we talk about definition, cost includes what cost includes. Cost include purchase cost, conversion cost, and other costs incurred to bring inventory to its present location and condition. On the other hand, NRV means the estimated selling price minus the cost to complete the sale. Why it is important in practice as an auditor and professional, the challenge lies not in the formula but how to calculate that cost or how to determine that NRV. Specifically, when price fluctuate, goods are damaged or item become obsolete. That's what we explore next through some real world practical cases. So, inventory valuation has direct impact on both profit loss and balance sheet. Even a small overstatement or understatement can distort gross margin, working capital, and income tax liability. It is also a key audit area under CARO 2020 clause 3 section, where the auditor must specifically comment on the physical verification and adequacy of procedure for inventory valuation. This is the one of most common areas leading to qualification in statutory cost audit report. From the compliance perspective, inventory figures are now closely linked with GST reconciliation and cost records, specifically for manufacturing and trading concerns. Any mismatch between books, GST9 and cost audit data often point to valuation or cutoff errors. In short, AS2 is not a theoretical requirement, it is a standard that directly tests quality of accounting system, stock control and management oversight. So, in the first few slides, we will discuss what are the cost component, etc. When we talk about the valuing inventory, understanding the cost component of cost is crucial. Under AS2, the total cost include purchase costs such as price, import duty, freight, handling, but it excludes recoverable taxes like GST input. Next is conversion cost, which cover directly labor, production, overhead, excluding any abnormal wastage. Finally, other costs may include design or transport that help to bring that inventory to the present location and condition, not administrative or non-essential storage costs. This clarity ensure uniform valuation and avoid inflated or distorted stock value. Moving forward on the practical cases, that is, first is obsolete stock, a situation most of us encounter during audit. Here, the company has finished goods of worth 15 lakh that have become obsolete. NRV is estimated at just rupees 3 lakh. As per AS2, inventory should be valued at lower of cost or NRV, so closing value should be 3 lakh. The 12 lakh written on off must be charged as expenses in the profit loss account and disclosed under the change in inventory. As an auditor, we have to verify management and RV estimate, check have to check aging analysis, market demand, and post-year end sales to ensure that the loss recognition is fair and not deferred. Case two, intercompany transfer. So we Now, in the present scenario, one stock goes to its sister concern or intercompany. Intercompany transfer a classic issue in group accounting. Suppose one gr- group company transfers goods to another at a 20% gross profit, and these goods remain unsold at the year end. In consolidation, while consolidate the group, we must eliminate this unrealized profit because from the group perspective, no external sale has been taken place. Therefore, the inventory should be valued at cost to the group, not to the transfer price. From the audit viewpoint, check the intercompany transaction schedule, ensure elimination are made during consolidation, and verify management has not overstated group profit through internal transfer. Next case is for the joint products and byproducts. We deal with situations where multiple output arise from single process, for instance, oil, refinery, and dairy processing. Suppose a joint cost is 20 crores. As per AS2, we first deduct the NRV of byproduct since they are incidental. The remaining cost is then allocated to main product based on their relative sales value. The key here is consistency. The allocation method should be consistent and uniform from year after year. From the audit perspective, review whether byproducts are correctly credited to the main cost and ensure valuation aligned with the management cost sheet. Now, case 4, that uh, for the goods in transit, infrequent audit query. It is a frequent audit query during the year on year basis. A item is shown in the balance sheet as a goods in transit. So we will discuss this case. Suppose an invoice is dated 30th March, but the goods are received on 3rd April. Whether these goods should be included in inventory depends entirely on when ownership is transferred. If the sales is on the FOB shipping point, ownership passes when goods leave the seller premises, so they should be included in the closing stock of our entity. But if it is FOB destination, ownership transfer on receipt only, so they should be excluded. They should not be included, and the value should be excluded from our financial statement. That as a key as an auditor, we have to verify terms of delivery and bill of lading dates to ensure inventory cutoff and liability recognition are correct. Case 5, WIP. Most gray area while auditing and preparing financial statement. बैलेंस शीट मैच नहीं हो रही, WIP में डाल दो, या कोई भी एडजस्टमेंट है, हमको हमारा डीपी बढ़ाना है, WIP में डाल दो, वैसा सारा एडजस्टमेंट चलता है. Which deals with partially completed job at reporting date. As per AS2, the WIP should include all direct costs like material labor along with systematic production overhead that relates to bring the goods in their current state. However, any abnormal cost, say idle labor or abnormal wastage, must be underutilization of plant must be excluded from the valuation. Finally, as always, WIP measure at cost or NRV, whichever is lower. As an auditor, this is a sensitive area because even small over understatement in WIP dis, distort gross profit. So verifying cost sheet and production report is key. For the case 11, our next case is uh, goods sold for the charity or CSR. In MNC and where CSR is mandatory, this scenario is becoming common in corporate audits. Here, the company purchase goods like 200 blanket for CSR distribution, but a portion remain undistributed at the balance sheet date or at the year end. Since these goods blanket have no realizable value, the entire cost should be expensed under CSR as per Companies Act and AS2. The important aspect is to disclosure, quantity and purpose should be clearly mentioned in the notes to accounts, ensuring transparency. For auditor, it is essential to confirm that such items are not carried forward as inventory but charged as CSR budget in the current reporting period. Moving forward to case 7, GST versus booked stock. So, as Tajir sir says, now uh, main tax audit goes around only GST reconciliation. We have to check every bill and GST input मिल रहा है 2A में आ रहा है 2B में नहीं आ रहा है. We have to check all that. So next case led to this. A practical issue auditor faced during verification. Suppose the book inventory is 50 lakh, but as per ITC register, it's showing as 55 lakh. Means the purchase which is reflected in 2A is around 55 lakh. This difference often arises due to the blocked ITC or non-creditable item or other expenses such as personal or exempt goods. As per AS2, inventory should be valued net of recoverable tax, so we must adjust costs for any block ITC and adopt the verified cost between 40 to 48 to 50 lakh means whatever the cost goes to the purchase amount means to the stock only. The final step is reconciliation and disclosure, ensuring the values match between GST books and financial statement, which is specifically important in statutory and tax audit. Now, next case for the digital and software inventory. So the now we are is uh, software industry is growing drastically in India. So, digital or software inventory, which is increasingly relevant in today's tech-driven business. Here, the treatment depends on the purpose of license. If the company purchase software for the resale, it fall under AS2 and shall be valued at cost or NRV, whichever is lower. However, if the license is for internal use, then AS11 will be appli- applied instead of AS2 since these are not inventory but long-term asset. So the accounting policy need to be clearly disclosed. The basis of classification, valuation, and distinction between resale and sell use software should be properly disclosed. So from the above slides, some red flags or audit aspect we can say. First, the obsolete stock, check the easing and NRB to ensure timely written down. Intergroup transfer, verify the unrealized profit are properly eliminated during consolidation. For WIP, cross-check the overhead allocation are logical and consistent with production level. When goods in transit, accuracy of cutoff procedure determines whether the stock is correctly included or excluded. GST difference, as discussed, are another common issue that always reconcile input rate and blocked ITC before final valuation. And lastly, CSR inventory should be checked for proper classification and disclosure, ensuring it is not overstated in books. These are the checkpoints which strengthen our audit quality but also help identify early indicator of misstatement and poor controls. Moving forward, some advanced case studies. In case of we examine a situation when goods worth of 40 lakh were destroyed by fire and an insurance claim of 30 lakh has being filed. As per AS2, inventory must be valued at recoverable amount. So we will write down the stock to 30 lakh while the balance 10 lakh is recognized as abnormal loss in the P&L account. From the audit aspect, it is crucial to verify FIR survey report and insurance claim settlement to ensure the loss claim are properly matched and disclosed. Next case is like post year end price fall. Silver is moving like bubble. We don't know whether it's a decline or whether it's appreciation. We can check this particular para in the case of jewelry business or the commodity business. So in case the cost of inventory, suppose let's say 80 per kg, but after the balance sheet date, the market price fall to the 70 kg. Ace to require adjustment only if the fall value existed as on 31st March, not for the event arising after year end. Hence, as an auditor, we must review commodity price trend and purchase order around the year and date to determine whether the decline reflect a pre-balance sheet condition or a subsequent event that require disclosure only. We obviously we have to disclose in notes, but that revelation not be done at the balance sheet date. Now under A11, next case is like consignment inventory. A goods worth of 12 lakh were sent to consignee, out of which 4 lakh remain unsold at the year end. Is under AS2, ownership of goods remain with the consignor until they are sold. Therefore, the unsold portion of 4 lakh must be included in the consignor stock, closing stock, not as consignee books. From the audit aspect, it is important to match or get confirmation from the consignee, verify sales report, and ensure correct valuation and cut off to avoid understatement of uh, or overstatement of inventory. In the manufacturing unit, we often deal with such situation where there is an idle plant and overhead. We discuss a practical issue. Like suppose a factory is running at 40% capacity and fixed overhead of 20 lakh as per AS2. Overhead absorption must be at based on normal capacity, not on actual basis. This means only the portion applicable to normal output is included in inventory valuation, and the unabsorbed portion, that is 12 lakh, should be treated as expenses in the profit loss account. From an audit aspect, always verify capacity utilization, records, production reports, and management explanation. Since under and or absorption can materially distort our gross margin and valuation of stock. Next case is like inconsistent valuation. Suppose a company or an entity having multiple branches, having different location of inventory. So they use different inventory valuation basis such as FIFO at one branch and weighted average at another. As per AS2, consistency is key. The company has to should adopt a uniform valuation method across all the location to ensure compatibility and reliability of financial statement. If there is change in method, say from FIFO to weighted average, the impact on profit or inventory value must be disclosed as a change in accounting policy under AS 11. From the auditor aspect, inconsistency is a red flag. So always cross-check valuation method across location and ensure proper disclosure in the notes. So what are the common error or what are the common areas we can look out as valuation of inventory. We can recap the key practical mistakes and audit red flags we often encounter in this field. First, many errors stem from the cutoff issue, where goods in transit are ignored and wrongly booked. We also find overhead fully absorbed during idle period and overstated inventory value. Similar NRV testing for the slow moving or obsolete item is often skipped, and auditors tend to rely only on management certificate without physical verification of inventory. Another frequent issue is inconsistent valuation method. For example, using FIFO in 1 year, weighted average in another year without disclosure. We also see admin and finance costs wrongly capitalized CSR stock dated as asset and GST input trade incorrectly included in costs. Each of each of these can materially misstate profit and inventory figures. From the audit perspective, a disciplined approach helps. Always she start with cutoff verification using GRN and invoice matching, review aging report for obsolete, and test overhead absorption against normal capacity. Ensure the book stock match GST data and obtain management representation for NRV where estimates are involved. Now, lastly, uh, never overlook the disclosure requirement. Valuation method must be consistent and any changes should be reported as per AS1 and AS5. In essence, AS2 is just not about post or NRV, it is about the integrity of the entire financial reporting process. A careful review here ensure the profit isn't overstated or understated, that the balance sheet truly reflect organization operational reality. That's from my side. I extend my gratitude to respected chairman, vice chairman, and moderator for their guidance, and thanks all participants from their keen attention. I hope this session enhance your audit approach and professional confidence. Over to uh, sir, Hemant sir. Any query we can discuss here?
Sir, we have no query till now.
Okay. Thank you, sir.
Thank you, sir. Uh, on behalf of CP committee, I extend our heartfelt thanks to CA Anup Rata sir for his insightful and engaging deliberation on the topic AS2 and AS11. Sir, your valuable knowledge and practical approach truly enrich the session and enhance members' understanding. We are grateful for the time and effort you devoted to sharing your expertise with us. Thank you, sir.
Thank you, sir. Thank you, sir. Thank you, team ICI.
Now, when we are closing our this webinar for vote of thanks, we extend our heartfelt gratitude to our esteemed speakers for sharing their valuable insights and enriching our understanding through an engaging and informative session. All speakers' contribution has truly added immense value to the program. We also express our thanks to the members and participants who attended the webinar and with great enthusiasm. Your active participation and keen interest made the session truly meaningful and successful. Thank you all for being part of this learning journey. I am very grateful to CP committee for giving this opportunity to act as moderator of today's webinar. Thank you. Thank you, sir.
Thank you.
Yes, you can close this meeting.